good morning from Hong Kong. Thank you for joining us. What's sentiment right now in the U.S. across, at least around Chinese equities?
Good morning, David. I think investor sentiment is shifting for the region. I mean, we've seen comments from some very outspoken investment managers for large institutions that are more positive on the region relative to valuation. I think taking a step back, it's clear that some of the social financing activities that happened in China has definitely helped to support equity valuations historically. Now that we move through this summer swoon of concern of regulatory change that really caused investors to take a step back, I think now investors are looking at some of these equity valuations and looking at the fact that I think Beijing is trying to strike a balance. There's definitely political pressure in the region, but at the same point in time, if you're trying to create change, you're trying to support the second largest economy growing moving forward, you have to see that it's encouraging that some of these policy regulations are very targeted. And at the same point in time, you have companies like Tencent, for example, stepping into the market, David, buying back shares, which is an encouraging sign that valuations might look attractive.
So let's put everything together, Brian. Would you be recommending getting into these levels right now if I still don't have any exposure?
I would say from a global equity perspective, it definitely makes sense to have some exposure to the second largest economy in the world. And keeping in mind that as the economy goes, sometimes so goes China. And that's a correlation that we've seen play out historically. However, we need to be cautionary as well that the environment still changes and regulators have the ability to change their mind as well. So I think having some exposure makes sense, but there's also a little bit more to learn as the year plays out.
So, Brian, yes, is bad news still good news?
Well, I think bad news is still good news when you think about the Federal Reserve policy measures around interest rates, for sure. I think some of the news that shows that labor markets are taking a longer time to recover. We obviously have an impact on Delta, which has impacted the global economy, domestic economy in the U.S. We still have supply chain and labor inefficiencies that are out there. So an accommodative environment is going to continue. However, at the same point in time, the economy has not fully recovered, but these growth numbers are still very encouraging. So I think the Fed is going to provide some sort of guidance in their September meeting on bond buying or quantitative easing starting to taper later on this year, beginning next year. I think they probably wanted to start the clock a little bit earlier, but we got a recent soft jobs report, and the fact that schools have not fully reopened and we still are seeing if people are going to re-engage with the expiration of extended and enhanced unemployment benefits, they probably want to see one more jobs report really before that timeline is set. So I think in some ways, everything is kind of getting recalibrated right now. But keep in mind that markets valuations are really driven by earnings. And earnings have been solid, and outlooks into next year still look robust. So we're going through a seasonal adjustable period right now, but we still think that there is more room to run, and we're optimistic about that over the balance of this year into next year.
Yeah, I think we have some data on that. 8%, I think, is EPS growth forecast in terms of earnings for next year. Does that seem quite low for you at this point in time, given how things have softened but might recover into 2022?
Well, we have to think about it on the whole balance of the global economy or domestic economies as you look at it. I mean, for example, last year, the tech sector contributed to the majority of the returns in the market and the resilience of the market. While this year, cyclicals, small caps, even the opportunity that I think still exists in international equities, for example, I think hasn't fully been baked into the cake, so to speak. So, some of these EPS numbers, we've also seen that analysts have also been very pessimistic since recent earnings reports have beaten on 90% of the time. So I think moving forward, price as it relates to earnings is growing faster than price. And I think that's a good news item paired with still the Fed being accommodative and also other fiscal policy measures that we see, especially here in the U.S., with Washington still being willing to spend.
Now, as far as the biggest risks are concerned that you flagged, geopolitics and obviously rates and inflation, not that those aren't risks, but those are risks that people are watching for anyway, fairly obvious. Is there anything that's brewing in the background that we should be paying attention to?
Well, I think the biggest thing that's really brewing in the background, David, is wage inflation. Wage inflation is definitely the biggest driver of concerns for margins for companies moving forward. We know that people re-engaging in the labor force has definitely taken longer than expected, and we definitely expect that that is going to be elongated into next year, coupled with supply chain inventory management issues that are taking longer to rebuild. I mean, look at the semiconductor situation and how that relates back to the auto industry as an example. So I think keeping an eye on those two types of inputs and how that impacts overall decisions on interest rates are one to flag for sure. But let's be fair, policy mistakes can be made by our friends in Washington and the Federal Reserve. And that has been academically and historically documented. So we can't keep that one out of our mind as well. But I know everyone's working hard to make the right policy decisions, and I'm optimistic about that moving forward.